Am I a bit dark, Wendy?
Are you a bit dark?
Yeah, is my room a bit, is it all right?
No, it's fine.
Yeah, okay.
No, it's absolutely fine. Let me turn this off now. Yeah, no, you're all good. Right. We've got 3 minutes.
2.5 minutes, I think. Actually, I thought it was later than that, but
I don't get halves on my computer.
okay. Hello, Johan. By the way, I'm going to throw the first question at you about why the thefts of cryptocurrency problem seems to be getting worse, what's causing it, and what's going on in DeFi, where most of the crimes seem to be being committed these days. And again, what can be done about that? And Dale will chip in a bit after you've said your piece. So I'm afraid you're going to have to take the first ball, I'm afraid. Take the shine off the ball.
Delighted to, yeah.
And I don't think, have you been on this before? I don't think you have. So just respond to people naturally. When you want to make a point, don't always wait for me. Just join in the conversation, keep it as natural and flowing as you can. I'll obviously make sure we keep moving through the topics, but do make it conversational.
No hand gestures, no little signs tell us to skip on, move on. I'm just gonna clip us off.
Yeah, it becomes obvious really when a topic is exhausted.
Yeah.
And you get sent off highways and byways by the audience if they ask questions, which they almost always do.
Yeah, they do.
Are we going to be doing our own intros, or are they going to be done by self, Wendy? Or
I'll do the intros. I'll introduce you all. I'll introduce the topic and you, and then ask the first question, and off we go.
Okay.
Right.
Wendy, on your countdown, make sure you say blast off as well.
Okay, I will.
So I'm not always sure.
Well, when we do the transcripts, we have this AI program that does the transcripts, and it comes up with all sorts of weird things that I say at the very beginning, like blast off. Okay, 5, 4, 3, 2, 1, blast off.
Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar. Is the digital asset custody industry ready to grow up? When we last visited the topic of digital asset custody almost exactly a year ago, blockchain-based assets were still discussed mainly in terms of who exactly would be disintermediated. Our then somewhat unfashionable theory was that the humble business of custody could probably do more to ignite the security token markets in particular than any other single form of service provision. Now, 12 months on, security tokens have still not taken off. Indeed, in terms of volume, in terms of value, NFTs and DeFi notwithstanding, digital assets as a whole are basically still cryptocurrencies, and Bitcoin and Ether in particular. But I think a lot more people, including importantly the venture capitalists who are now putting money into blockchain-based custody services, seem to agree with our supposition that safe custody is a crucial ingredient in the expansion of the industry beyond cryptocurrencies. Why? Well, most obviously because cryptocurrencies are still being stolen regularly and on a large scale, which casts a blight not just on cryptocurrencies, but on the prospects of tokenization as a whole. Secondly, it is still not easy to move cryptocurrencies from one blockchain protocol to another. Again, that's something with the traditional infrastructure in the securities industry of custodian banks and central securities depositories existed to facilitate, if not always with complete success, particularly across national borders, but it is what it existed to do. Thirdly, and above all, there is now a near universal recognition that the future of the token industry lies with institutional money, and institutional money will not come at scale without adequate custody arrangements. So today we're going to talk about the insecurity of cryptocurrencies, their impact and the prospects for tokenization, why so much venture capital money is going into digital asset custody now, what traditional custody service providers are doing and should do about it, and how new the new value-added custody services actually are. To help us do that, we're joined by Massimo Butti, the Product and Business Development Director at SDX, the digital exchange and CSD owned by the Swiss Stock Exchange. Johan Bornemann is the product lead for MetaMask Institutional, the part of Consensus that provides an institutional quality digital wallet, which can also free its users to interact with DeFi apps. Sven Werner is head of digital custody and payments at State Street Digital, the division of the global custodian bank that covers cryptocurrencies, central bank digital currencies, and tokenization. Dale Quantz is Chief Technology Officer at Polysign, builders of the standard custody and trust company, an institutional grade custody, escrow, and settlement platform for digital assets. Neil Fillery is co-founder at Shuttle Holdings, a private investment office focused on digital assets, and also co-founder of Digital Asset Custody Services, an institutional digital asset custodian. As always, in addition to our panelists, we have you, our audience. We want your questions, we want your comments, so please send them and keep sending them throughout this webinar using the Q&A functionality at the bottom of the Zoom screen. I will not be saving up your questions and comments to the end, but I'm going to address them as we go along, so you can be, if you choose to be, an integral part of this discussion right from the start. And I think all six of us will be very disappointed if you don't take that opportunity. Well, I'd like to kick our discussion off by asking Johan the obvious question. Scams, thefts, hacks, they've been a recurrent feature of the cryptocurrency market since hackers made off with $500 million of Bitcoins from Mt. Gox back in 2014. Chainalysis tells us that thieves stole $3.2 billion of cryptocurrency last year and already stolen another $1.3 billion this year. Most of it, interestingly, no longer from the original villains, the exchanges, but from DeFi protocols. 97%, says Chainalysis, of thefts have come from DeFi protocols in the first quarter of this year, against just 30% of them back in 2020. Since Mt. Gox, there have been no less than 527 cryptocurrency thefts. That's an average of 66 a year. And the problem seems to be getting worse, not better. So my question to you, Johan, is what's going on in DeFi in particular? Is it still the loss of private keys? Is it the vulnerability of code? Is it the breakdown of security processes inside these firms? Is it, as it used to be in the exchanges, insider jobs? Is it price manipulation? The bridges seem to have emerged as a vulnerability of late. So what's going on and how can it be fixed? After all, auditing the code doesn't seem to have worked. Should we be thinking about better customer due diligence? Should, in fact, the industry be embracing KYC, AML, CFT, and sanction screening checks to make sure that bad actors don't get involved with these protocols? Doesn't work very well in the traditional industry, but might help a bit here. So is there a particular problem with DeFi? What's going on? The code is open source, obviously, which means anybody who knows what they're doing can fiddle about with it. And the police don't seem to be very good at catching criminals. So Johan, what's going on in DeFi and what can we do about it?
Thank you, Dominic. Thank you to all. It's a pleasure to be on the panel. I think you've referenced some astounding numbers, and I think they can be very intimidating, sort of running through the hacks of the last several years. I think it's very important to note that obviously hacks are very serious. You have real money at stake, you have real lives at stake. And as we found in the recent Luna incidents, obviously, sadly, there were all sorts of loss of life tied to loss of funds. And so as an industry, as product built in the space, we have to take this very seriously. We have to think very deeply about how do we build the products, the infrastructure, the tools, the services to protect users. The important thing to note, though, is that we are very much in a Cambrian explosion. And therefore, we have innovation cycles that are second to none. And in that innovation cycle, you are going to see experimentation being run, experimentation is failing, and then often with that, as you correctly pointed out, egregious behavior. And you tend to find this in every single innovation cycle, that despite the changing technology, human behavior does not change. I am deeply optimistic, though, despite all of that you are seeing a range of tools, a range of products, a range of services being built to cater to these problems. And I think it starts with a giant topic that we're discussing today, which is how can institutions and how can users have the safe storage of their private keys? How is key management done? How does signing happen? How can you manage risk around signing of transactions? Now, on top of that, you're seeing a range of new capabilities being built. Therefore, how do we decode transaction parameters so that users know exactly what are they interacting with? How can we have additional services around ensuring that we notify the users that are actually interacting with the correct smart contract and not a nefarious smart contract? And then lastly, and very importantly, making sure that we have the infrastructure in place that users can bridge safely, as you pointed out previously. Now, again, we are very, very, very early in this ecosystem. DeFi is incredibly nascent, especially when compared to the traditional financial system. And so what we already have is the future's already here, as the famous saying goes, it's not evenly distributed. And so what you will see developing really quickly over the next 6 to 12 months is sort of the building out of these services to help protect users, to help keep them safe. And so I am deeply, deeply, deeply optimistic that through decoding transaction parameters, through AML and KYT tools that exist in the market today, through decentralized identity, this industry can solve the problems that you have pointed to. And so maybe I'm the optimistic person on this panel, but I really sincerely believe that hacks, vulnerabilities will continue to trend lower despite the breakneck innovation in the space.
Dale, you've heard what Johan said. What occurred to me listening to him was that actually the traditional financial services industry actually has a very rapid development cycle as well. Ideas come straight out of business school. The next thing you know, they're being turned into financial instruments sold to German retail banks. So actually what's happening in DeFi, for example, isn't that different, from what happened in TradFi, if you like. So that you put finance and computer code together, you get very rapid cycles of development. But do you share Johan's optimism that actually these problems are soluble, partly because the cycles are so rapid?
Yeah, so I think I do share his optimism in that sense. But I mean, the same problems that traditional finance has, you're going to have in the DeFi model with cryptocurrencies and blockchains. But there's no silver bullet with this one. It's really a layered defense, and that's going to be embracing the traditional models that have definitely worked in terms of knowing KYC, KYT, and building further really professionalism, I'd say, within the context of the cryptocurrency and crypto exchanges. Because I think you've seen a lot of technologists and a lot of companies spawn up that did not have those deep traditional roots that would allow them to know the patterns and practices that were used to help mitigate some of these attacks that are basically hitting a technology front that are not as common in traditional finance. And so that's important. But I think the answer is as simple as it's always been. You've got to reduce the human touch points, eliminate as much of the human element as possible, and create as immutable a set of structures that are supporting your assets and protecting your assets as you possibly can. Every time something changes, there is a risk and opportunity for someone to come in and actually insert themselves and essentially hunker down within the actual technology stacks in order to wait for the opportunity to steal assets.
Mm-hmm. Sven, like Dale, you are aiming to service institutional money in the first place. And I alluded to some of the fixes which have been tried already. One is to audit the code of these protocols. Clearly, that isn't terribly effective. We've also seen insurance be introduced. And I've often thought of traditional custody as like an insurance policy. Basically, institutional investors are saying, well, I'll appoint State Street Bank or Bank of New York Mellon, and if my assets go missing, they will make me whole. It's like an insurance policy, possibly one for which they're not really paying the right premium, but it is an insurance policy. How sophisticated is the discussion you're now having with institutional investors about liability for loss? And how complicated do those discussions get? Johan mentioned, keeping private keys secure. That's not a straightforward task. Dale mentioned, trying to minimize those human touch points. That's not, that's hard as well.
Yeah, maybe just, I think that's an excellent question, and also reminds me in a way of many discussions, in particular we had in Europe around AFMD and liability regime. So probably always is a question, what do we mean by insurance policy? As a custodian, I don't think of myself as an insurance policy. What I do think of myself as a safe and secure place to store these assets. So obviously we put a lot of procedures in place to ensure that. And so the loss of asset that is being considered, obviously something that hopefully is a very remote chance of happening. Now, as you said, in the crypto industry in particular, it has adopted the idea of ensuring the loss of assets as an important means for that. But I would say this idea that you need to have insurance for crypto custody, for me, is a deeply flawed idea, as well as the idea that I hear that quite a bit more, I would say, from providers of fintech providers than necessarily from investors, which is that what you can insure, which is so far mostly cold storage, is therefore inherently more secure than alternatives. I think both ideas have some challenges. We could easily argue, and we hear this from investors as well, that a driver for the need of insurance, at least in the way the industry has been operating so far, comes from the fact that these are typically the smaller startups. They don't have the financial muscle and experience to deal with these kind of issues. So I would be surprised if you want the same dynamics will apply if institutional banks offer these kind of services. In the same way that also I think in terms of the what is an inherently better model for private key management, or the sort of code, whether these terms actually have any real meaning, I think it also has to be debated. What I find quite interesting, if you want, is the, I mentioned earlier, AFMD, some of these issues that we have been grappling with as a traditional securities industry will come back for digital assets. So if you look, for instance, at the proposal from the EU Commission around the DLT pilot regime, it makes it very clear that in future, a DLT market infrastructure in Europe offering tokenization of securities, equities, fixed income, what have you, it would be subject to a AFMD-like liability regime, like a strict liability for the loss of assets. So we see it's a complete shift, if you want, how you think about the traditional industry, where a CSD in that sense has no liability per se. Instead, you regulate the function of that industry. So I think that is, for me, an interesting aspect in terms of how the introduction of DLT to either financial instruments, or in the case of crypto, changes how we think about loss of assets and what the right regime is. But then saying everyone who's offering these services becomes an insurance policy, I think would be, from my perspective, a step too far.
Well, I'm interested you brought up the question of AIFMD, because that liability was extremely contentious with the custodian banks at the time, not least because a lot of the assets were not actually held by the custodian banks, but were being rehypothecated up the wazoo by prime brokerage houses. You don't have that problem here, do you? But you'll have a strict liability, but you will at least control the asset, whatever we mean by that. And we mean by that not information about it, not an entry in a register, but actually the asset itself. Lines of code.
Yeah, well, that is the thing. Do you actually? Actually, this was an interesting debate also recently in the context of the crypto sprint that the FCA has undertaken. When you think about if you want particularly in crypto, the absence of the product regulation. So who is creating that code, who's ensuring that if you have smart contract for tokenized assets, that the smart contract is actually doing what it's supposed to be doing. Who is liable for this? You have no framework to control this at the moment. And would this be an obligation in future that rests with an issuer? Or would you assume, which hopefully we're not getting there, where a custodian has to be a gatekeeper to almost assess the risk inherent in that code before allowing investor to invest in those instruments and consequently hold them in custody? It changes a little bit, sort of in the traditional world, you have a clear definition. This is a role of a CSD. This is a role of a custodian. This is what an investor does. With DLT, you have to rethink if that very clear delineation of activities still applies, and if so, how it's being enforced, and would the law have to change to actually reinforce this in the future world?
So I think I'm going to sort of make a comment off of what Sven had mentioned before, was that the role of the custodian is necessarily to actually decide what assets they decide they're going to custody. And they are looking at, deep sets of information on each of the assets they consider to custody, because it does create a risk profile for their customers, right? So having the assets, in the case of of a custodian having the assets in their custody system and secured, yet subject to a contract that might allow those assets to be lost, that's a really important factor in terms of considering whether you're going to custody that sort of asset. So I'm not saying we go all the way to the liability side, but any good institutional custodian should be looking at the assets and rejecting those that don't have a highly decentralized base, that don't have a set of patterns and practices in terms of their trade profiles that look like they're normative versus having money laundering, other nefarious activities in there. So.
I may just respond to this, if I may. So obviously I know about the idea of coin policies, etc. But you have to ask the question. So, at what stage do you then, as a custodian, become involved in the portfolio decision of an investor? Because it's almost saying today, obviously, we look at country risk, market risk, CSD infrastructure risk, and making determination what is a good framework around that and which market we are comfortable. But here it would be almost saying you go, let's say the UK, and saying, I'm happy to custodize BP shares, but I'm not happy to custodize some other FTSE 100 share because of something in the code behind it. Now, this can be very well done, and maybe that is a consequence of the move towards DLT, but it is a quite a move away from the traditional world where that level of, if you want, security by security
scrutiny
decision is something that a custodian typically wouldn't do.
Yeah, but I think that given the level of transparency that can take place when assets are actually managed and issued and available on public DLTs, you have that additional information, and we shouldn't be ignoring the information in terms of our decision-making process. That's my point.
Mm-hmm. But Sven, how often, as you look back over your career, has State Street been able to say to an institutional client, well, you may be investing in that stuff, but I'm afraid we are not able to keep that on your behalf?
That is, no doubt, that would be a significant point of contention with institutional investors. But I think that the problem is, and this is with all due respect to sort of the colleagues from the fintech industry, there's a different dimension how a regulated financial institution like State Street will be looking at, because you have on the one hand side custody regulation, but more importantly you have asset management regulation, FMD, UCITS, what have you. So these kind of decisions have a more complex implication from that perspective about who takes the liability for these decisions and what is the criteria you have to apply to make the decision in the first place. So the crypto industry at the moment is not exposed to these requirements. We need to bring them in line to say, in future, when the portfolio manager makes a certain decision, what is within their remit versus the custodian. That's a unresolved issue, if you want, from a regulatory perspective.
Now we're starting to get some questions come in, which I will ask in just a second. Before I do, perhaps Massimo, you would want to contribute to this discussion about the question of liability. After all, at SDX, you built yourselves a whole digital CSD to sit alongside your traditional CSD. So you must have been thinking about the liability question as well.
Well, yes, and we also had to strike a balance between the liabilities that we, as an FMI provider, are willing to take on board, and also the liabilities that we share with the custodians. And it was an interesting. There were some interesting conversations in there. I think that we reached a position now where we are happy that the CSD, the custodian role on our CSD, has struck that balance. A lot of it hinges around known processes and processes that we have re-engineered and sometimes reapplied from the world of TradFi, whereby a lot of these controls and these checks are already embedded, for example, in the format of the membership to the CSD. Questions about auditing code, it becomes very much and very rapidly a contentious conversation. So I guess that what we are aiming at going forward is to try to really work and to fulfill our role as an FMI to create as much as possible standards that can be used within walled gardens like ours, but also externalized very easily, and then bridged between the two. However, as you pointed out, the bridges seem to have been the weakest link in the recent crisis. So I think that there'll be a lot of work that we will have to do with members, with technology providers as well, in order to reinforce those bridges, because we see them as key to create more liquidity around assets, but also more opportunities to go to offer custody services to a more diverse set of assets. And also, I think that will go towards creating new roles where, for example, risk management at CSD level and at custody level will look more at portfolio diversification, but also at exogenous risk, for instance. So to answer your question, we reached a happy balance, but is not the final state. And I don't think that as an industry we will reach that very soon. But one of the key points here is that we have readapted some of the TradFi processes, and also some of the thinking behind these assets. Probably for us it's been easy because we are also working with assets that are fairly traditional, in a sense, in terms of asset classes. But as Sven was saying, we would like to prevent a situation where you are saying, as a custodian has to say, oh, we are taking on this share on tokenized form, but not this one, because we're not comfortable with the protocol risk, if you want, connected to that tokenized asset of that particular company. I think it would be tremendously destructive. And if we can work with the industry as an FMI to solve that and impose, not impose order, but impose a set of rules that we can all happily live with. And because again, there is no silver bullet to solve this one. We can't certainly provide an answer in terms of substantially increasing safety of these assets without compromising the safety of the CSD. So it's a balance that needs to be reached with that in mind as well.
But to cut to the chase on that balance, have you been able, in contracts with custodian banks that operate, have accounts, if you like, at your CSD, specifying who is liable in different situations, or is this something you're going to have to learn with experience?
Well, no, there are.
What happens if the CSD fails or falls over or loses the asset?
Well, if the CSD falls over, we have assets segregated in two types of omnibus accounts, where the banks are required to settle their proprietary position and their clients' positions. And then underneath the client omnibus accounts, we offer account segregation. So there are individual accounts with the beneficiary owners of the accounts information embedded into the wallets, if you want. Beyond that, as I said, I think that this sort of builds a layer of security that everyone can understand. Is simple, as I said, is very much adapted from TradFi. Certainly, as we expand our ecosystem and we start to look at assets that are, for example, perhaps not native in our environment, we will certainly have to go deeper in that, and perhaps there will be some levels of technology protection that we need to provide, or we will have to ask the custodians to provide.
Okay.
Yes. I was going to say, I agree with Massimo in the sense that segregated accounts, you kind of mentioned it, is one way of actually mitigating the risk of loss should there be any breach. Coming back to just the asset mix, and I wanted to clarify my statement in saying that what I meant was an asset type, we need to look at it in terms of to determine whether it's actually securable. In other words, before we were willing to take that on as a custodian. That's a different statement than to say, well, based on the patterns and practices, what's going on in the protocol, we don't want to take on that asset. I'm really talking about, as a custodian, we're responsible for the security of those assets. So we need to make sure that we have high confidence that we can secure them and allow them to trade the instruments as necessary. But that's the differentiating line for me, not whether or not we think this is an asset we want to custody because of other outside factors. This is just really about security.
Mm-hmm. Now, Neil, you've been very, very patient. Can I throw at you a question from Trevor Hunt here, who says, climate-friendly digital assets, is this an oxymoron? I assume he's referring here to the fact that digital assets consume a lot of electricity. It's slightly off our topic here, but I wonder if, as an investor, you come across this as a barrier to entry.
I don't necessarily think so. I think he or she might be pointing towards the fact that there are a whole bunch of alternative energy uses for the mining of cryptocurrencies. Perhaps that's the climate orientated question. I'm not sure, but we've certainly seen, that come to fruition because of the computational power that's required to mine, some of these assets. Of course, things like hydropower and some of these other mechanisms are becoming, blue power is becoming more and more of a influential energy source to power the mining equipment that's required. These very power intensive ASICs miners, for example, and we've had a lot of experience in buying and selling miners from the beginning of time when this space came about. But just going back to the custody elements, I think just a couple of points. For us, when we first started in this business, back in 2014 was when we really hit the market. One of the key things for us was the core infrastructure layer of custody and digital identity. So having a combined self-sovereign digital identity layer and a secure custody solution was absolutely paramount to get ready for the institutions and the regulated world. So we spent a lot of time in actually, there's always this conundrum with business owners and institutions is this high availability of the asset class versus, how secure you need it to be. We took the stance that if we're managing money or we're advising investors in a regulated environment, you can lose money, markets go up and down, but you can't lose the private keys, right? You can't go to an investor and say, holy crap, we've just lost the private keys of your assets. So we took a very strong view that the core infrastructure to digital assets had to come from a custody solution that didn't have, this was mentioned earlier on the panel, eliminate single points of failure. We want the highest grade hardware to be able to back up our back end, right? So when our assets are in flight, that's one thing, and that's where I think typically the insurance comes in place when assets are in flight, meaning in a hot wallet scenario, right? So we looked at cold storage and actually thought that there are issues around that, of course, because you're relying on a party to perhaps go in and unlock a vault in Switzerland when there's human intervention that might cause a problem. So we went down the route of building an end-to-end trusted computing environment that was a warm wallet based solution that arguably was more secure than cold storage. So I think these aspects are very, very important, and that was really sort of dear to our hearts when we started in this business.
Mm-hmm. Do you think those different technical solutions like multi-party computation, the hot, cold, warm wallet, are these actually a source of competitive advantage to anybody anymore? Or is there kind of a standard that's sort of emerged where you have to meet this minimum requirement?
Well, we were doing a form of multi-party computation before the term was defined, and we had a trusted computing environment that we built with IBM, which enabled us to have those aspects within our custody solution. And then, it was really designed to be built for the largest banks and custodians in the world. And that was our approach. We need something that we can scale. We need something that can be, hyper secure, from sort of military grade HSMs right the way down to having the ability to be able to service a high frequency hedge fund. Very, very difficult to do, right? Because you need to have the high availability of the asset as well as the secure storage on the private key side. But yeah, that's really the nuts and bolts.
I'm looking at my external hard drive here. I'm wondering if it's military grade. It doesn't look it, but
so just to Neil's point, I think really quick, I think it's critically important that we have a zero trust model that is within our custodial organization. Anybody that has the ability to touch or access keys creates a risk. And so that's why, for instance, we've built a model that is just a zero trust operational model. No one within our organization has the ability to move assets but the owners themselves. And that's key.
I couldn't agree more. I mean, putting ownership back into the user for a self-custody is absolutely paramount. And I wouldn't trust anyone actually to be touching my private keys for the assets. That's not because I don't trust people at times. It's just that I don't think that that single point of failure can be eliminated through technology. And I think that's important when you build an architecture. Yeah.
I think maybe, Dominic, to your point, you referenced this phrasing of competitive advantage. And I think it's maybe a sort of a strong phrasing because you tend to find different users, particularly institutions, have different needs in terms of key storage. I think sort of the panel seems to be in an agreement around a single point of failure being a very important point to consider. But certainly what we find working with 7 partners globally, offering custody tech, qualified custodian, MPC, HSM, all these various different flavors that you have referenced, you tend to find that different institutions have different trading strategies, different books, different requirements, different regulatory oversight that then drives them to a particular type of key management solution. So again, I think competitive advantage is maybe a strong phrasing. I think the market naturally drives different requirements, and therefore you're seeing the adoption and you're seeing the innovation around different key storage solutions.
While I have your attention, Johan, what about retail investors? They seem to have been very comfortable with some pretty cacamamie custody solutions. They don't seem to have paid that much attention to it, which has made them vulnerable to being losing their assets. Is the reason for that it's simply too difficult for them to purchase a safe custody solution? Does there need to be easier on-ramps for retail investors in particular in cryptocurrencies and beyond that eventually in security tokens as well?
Yeah, I think it depends on how are we defining what custody is in this instance. If we're talking about obviously traditional custody services in terms of an entity signing on your behalf or storing those keys, I might take your point. Although we have seen innovation, particularly in APAC market, around HSM providers providing infrastructure to solve for retail users. Your point, though, I think comes back to some of the earlier points referenced by some of the other panelists around this idea that when you're talking about the retail market, you're definitely seeing a more active user stepping more actively into crypto generally and more stepping very actively into DeFi, and therefore naturally interacting with a range of different tokens, DeFi protocols, bridges, etc. And that by its very nature drives a type of need for key storage, key management and signing yet again. And so what you've seen is, custody tech play a profound role in terms of serving consumer needs. You've seen recently the adoption of MPC technology to roll out for a variety of different large institutions that sort of cater to consumers, as well as MPC playing a very big role in providing infrastructure and sort of the crypto rail sitting behind, a lot of B2C fintechs today. And so I do think there is a way, sort of you think about custody infrastructure and custody tech serving consumers in a way that can solve for the single points of failure. And there's also obviously, hardware wallets that I think play a very important role in the consumer space. Again, it comes down to cost structures, the cost of paying for a qualified custodian. It comes back to previous points around insurance as well. There's sort of a unit economics that does not make sense for the average consumer, but there are, I think, really important solutions that I've developed in the market today that does give that freedom to the consumer and also provides them with security around signing and storage.
Now, we had an interesting question from a member of the audience here who says, today, sequential process compliance costs are killing us in the securities market. They're very manual. There are lots of people. They vary by markets. How can we fix, automate, and evidence this cost and risk processing effectively in a distributed ecosystem for cryptocurrencies and tokenized securities? Now, we've talked about regulation of the cryptocurrency market. There's a kind of supposition now that it's going to happen. It would be good if it was, because it's casting this blight on the whole tokenized side of the industry as well, and the DeFi side of the industry. And so regulation is kind of good. And there is a convergence of opinion that outside the extremes that regulation of crypto would represent an advance. But here we're being asked, actually, we've got lots of regulation in the traditional securities industry. It's killing us. It's incredibly expensive. It's totally ineffective. And actually, we need a whole new system. So I suppose the question is, how quickly can we move to a tokenized future? Massimo, SGX is betting on that happening quite soon. What's your thought process?
Well, for us, our bet is based on the fact that Swiss legislation actually has created the background conditions to create a market, in a regulated market in digital assets. So I think that regulation hopefully will bring more clarity, reduce fragmentation, especially in Europe, and there will certainly be efficiency gains and benefits deriving from that. That's for sure. However, at the moment, so there's still a lot of disagreement even at national level, or how this regulation should be shaped. Just look at, again, deposits and custody, use of, we just mentioned use of private wallets and private keys, keeping track of security and assets movements across different what are regulated but still fragmented jurisdictions. So it's a gigantic puzzle to solve. Our bet is that the Swiss regulation can be a good reference point and a good starting point for other legislators, because I think it's been very pragmatic and very open to the concept of creating markets and support services around these markets. So I guess that, and I don't want to be facile, but again, is a matter of make an effort to strike a balance between the trade-off of have adequate investor protections and adequate recourse in terms of failures, and a regulation that becomes a burden to investors without really solving any real pragmatic problems. I think that in the case of DLT, there'll be a lot of technical solutions that could easily solve the burden of rather hard and heavy regulatory measures. Again, I think that our bet is that as also the regulators become more comfortable with what we are doing, and let's put it pragmatically, we're not breaking anything. They will probably become more comfortable and being able to be more also very pragmatic in adapting the regulation to the purpose of what they're trying to regulate. So it will require a lot more detailed discussions than in TradFi. Because otherwise you're going to end up with some sort of very swiping pieces of legislations that blanket entire segments of the value chain. So I think that here we're going to be, we will need to be a lot more as market practitioners, a lot more active in counseling in that respect. And I think that the tech providers, the fintech providers, have a lot to contribute, and we have a couple on this panel. They are at the forefront of this, and I think that they can really bring technology solutions that can really help us as an FMI operator, but also the regulators and the legislators to really adapt the playground in a way that is accessible and fair for everyone.
Now, thanks, Massimo. Here's an interesting question. Who are going to be the winners in cryptocurrency? Traditional institutions, spin-outs, or native digital custodians? And that question interests me because at Future of Finance, we've been trying to track the number of digital custodians out there. And the figure it reminds me of the old fund administration industry, which seemed to fragment and consolidate at the same time. So there's lots of purchases and deals going on, but also the number seems to be increasing. The last number I saw was more than 100 digital asset custodians of various kinds out there. So it is a very fragmented ecosystem. Now, Neil, CB Insights claimed that more than $1 billion of venture capital money had gone into various forms of digital custody in 2020. What is the growth that those investors are seeing? It's not in cryptocurrency. Is it in DeFi, or is it in security tokens? What are they really betting on?
I think for me, there's a second wave within the security token offering market that's come in. When we looked at this, 3 years ago, and it wasn't so vibrant, we thought it was going to take off a lot faster than it did. But I think it's back. I think if you have the ability to look at the real asset market or the more tangible asset market and create, digital representations of those asset classes, that for me is the sort of holy grail as any investor, is to get access to other asset classes that you typically wouldn't be able to be bankable or in your portfolio, right? So one of our mission statements is to bring more tangible assets, real assets like real estate, artwork, that you name it, anything down to music rights and other asset classes. This is something that I think there are trillions of dollars of assets to unlock and to bring into client portfolios in the wealth and asset management space, right? So that's a big shift that I'm seeing. I'm seeing more and more, real asset asset-backed tokens coming to market, and to have an infrastructure to be able to support that within a regulated bank account would be actually something that we would welcome in the industry. I think from a venture capital investment standpoint, obviously we've seen the likes of Andreessen Horowitz and such big VC investors plowing billions into this, creating second and third funds there's no doubt that VC money is chasing the new sort of blockchain infrastructure projects out there, and this is a clear trend that we're seeing. In terms of institutions, who's going to be the winners and losers? I think that was a touch point. I think it's clearly evident that the large, custodians, the JP Morgan's, Bank of New York Mellon, State Streets, Citibanks, we talked to all these very, very early on. I think it's been a decade of education and people catching up to what this could really do. But now I think a lot more, many more institutional based corporates and groups have got their arms around it and are starting to put the investment dollars to work to really accelerate the growth of blockchain infrastructure in enterprise.
Sven, State Street could have gone into this crypto custody, if you like, back in 2018, but decided not to proceed at that point. You are now working with Copper to develop a service. I asked that question because Neil referred to a new wave, and there was a wave of crypto custody happening back in 2018, and there's a second wave of it happening now. What's your answer to this question from a member of our audience? You're not allowed to say State Street's bound to win, but what do you think the ingredients of a successful digital custody offering are going to be if you look forward 4 or 5 years?
Yeah, I would say, I think maybe part of the confusion comes from this, when we say custody, what we mean by this. And I think everyone still has a very different idea depending on which part of the ecosystem they belong to. When I think about custody, I think about an institutional platform that is integrated with accounting, risk management tools, basically is geared towards the needs of asset managers. And also it deals with the respective licenses, from depository licenses in Europe, etc. That bundle does not exist today. That is what we're building. And it will also be subject to one of the highest security measures when it comes to key management. So and this is, if you want, the issue that today we're servicing clients in asset owners, unregulated funds who have crypto investments. We're providing various kinds of accounting services around that. But taking, if you want, a traditional custody franchise into the regulated asset management industry is something that is subject to regulatory challenges. Take, for instance, UCITS regulation in Europe. A crypto investment is not an eligible investment for these type of investors. You could argue the lack of an institutional-grade custody solution may be one consideration for regulators to make that decision so far. And so that's something that, if you want, that real money asset management industry is still watching at the gates. And so therefore, I think by providing solutions that work for that part of the asset management industry, it will unlock additional investors to participate. And therefore, I don't really see sort of the heads-on competition between fintech. We are all having a role to play. And the cooperation that you just mentioned with Copper is one example. I'm just using technology where it's available. I don't feel, the competition. I think we can be very complementary on that journey.
Well, into our last 15 minutes or so now, I'd like to perhaps talk now a little bit about value-added services, if you like, which is something which has become very familiar from the traditional custody industry down the years. And value-added here means, for the purposes of this particular discussion, what's going on in DeFi, the staking, the lending, even the prime brokerage services which are being developed there. What is the attitude? And Dale, this is perhaps a question for you first, but I'd be very interested in what Johan has to say about this as well. What is the position of a if you like, a conservative institutional custodian supposed to take towards this? And Massimo, I'm sure, because I know you're developing a cryptocurrency yield service, if you like, as well. So I'd be interested in what you have to say. But Dale, why don't you tell us what's the right view for a custodian like you to take towards what is going on in the DeFi markets? Is this a big income opportunity for your clients, or is it something you need to be very wary about?
It's definitely a big income opportunity, but like I said, you also have to differentiate between which liquidity pools you're going to be interested in supporting, and that's really about securing the assets again. But I'm going to go back to something that Sven had said. Sort of, he talked around it as well. There's a whole set of surround sound services that go along with a custodian that have to be a part of the service, the front that you're creating for your customers, and the set of services for that is key. So, for instance, we as an organization just purchased a very large crypto custodian fund administrator in order to be able to add those set of services around the basic custody. And I think that's what institutions are looking for, and looking for a solution like that. And I think those folks that have a broader set of services that they make available from, within the confines of traditional regulatory framework are going to be incredibly important. Now, staking is one of those, I would say, perfect yield opportunities. I think there's real value and real security in being able to take assets and stake them. On the DeFi side, there's real value in being able to offer your assets up and move it into this decentralized lending model. You've just got to be concerned with who the partners are. And that really comes down to a couple things: diversification of the pool when you're looking at those assets to be able to embrace, and once again, the patterns that are taking place on the pool and its reputation. And that comes down to what assets we're interested in servicing. We want to service the broadest possible set of assets. We also need to enter in this realizing that we are beholden to our, like we're New York, a DFS regulated entity, and we've got to be able to defend our positions on what assets we decide to take on as a custodian and what services we offer with that. But I think great opportunity there, but obviously with the opportunity becomes greater risk. So we've got to be even more diligent in our processes, our human elements, and our security models to be able to support it.
Mm-hmm. Johan, opportunity means risk. What's your advice to digital custodians looking at DeFi?
Yeah, so normally we tend to see, and it's maybe an obvious statement, that regulation is directly causal and correlated with the adoption cycles of Web3 and DeFi generally. And so you have seen the likes of custody tech providers being able to step into the market more actively. And we're definitely seeing a crossing the chasm of more regulated entities, both institutions as well as custodians, thinking through how might they gain access to this ecosystem. So in a lot of our partners as well, so just to reference again, we work with 7 partners globally. These are licensed custodians, qualified custodians. We've definitely seen our conversations change as well over the last 6 months, with more regulated entities being very interested in accessing and providing DeFi services to their clients. Now, a lot of work we do in terms of integrations for them and working with MetaMask Institutional is helping them figure out some of the things that Dale referenced earlier, which is how might they allow list smart contract calls? How might they allow list tokens, DApp URLs? How can they build curated DeFi experiences for their users, given the risk that they have to take on from a regulation perspective? And we actually work with a partner that is a very heavily regulated institution that has managed to figure out to offer a very sort of curated experience of DeFi, so giving their users access to DeFi pools, a handful of DeFi protocols in a way that sort of ticks the regulatory boxes. And we've helped them sort of think through those problems and on the engineering side as well. The last thing I'll say is that risk assessment on DeFi pools is something that I think is very important. And we actually built a tool that can do this, can run pre and post trade compliance on DeFi pools. and then tell an entity what risk they are taking in terms of the pseudonymous counterparties within that decentralized pool. And that's something we're seeing getting sort of large usage and adoption from regulated custodians. And so again, I come back to maybe to my first point, and the fact that we are in a really important innovation cycle, and the tools that will allow regulated entities to move into the space are being built. They exist today. I think the struggles we have, the headwinds we have, is the uncertainty with regards to regulation. And I think that still provides a really strong headwind for more regulated entities to understand how to interact within DeFi generally.
Now Massimo, you have or are developing a service to offer clients who hold cryptocurrencies the ability to pledge them into the Ethereum network to earn a return for authenticating, validating transactions. It's a relatively conservative approach. You're not looking to go into the DeFi area. Conservatism is understandable in your case, but it still marks something of a departure from your original model. What's drawn you towards doing that?
Well, I think there are two things in play here. Is that one is that we see it as more than a departure, as an evolution of our initial business model, and that is, I think, based on our assessment that the opportunity, as we just heard, is quite substantial. Also, there is as Dylan and Johan have pointed out, there is a whole ecosystem surrounding that, and I think that regulated or say CSD centralized FMIs have a role to play to curate and orchestrate the relationship, as you said, but also to really be the connecting tissue between the different elements of the value chain. So in order to do that, I think that you have to go out there and try and start doing it, and really start to bring people over with you on this. And one of the things we are doing is really with our clients is redefine also what really the role of the custodian is, because again, there's so many. It's not only the custody and the asset servicing, but there are a lot more in especially if you're bridging into, or you're planning to bridge into DeFi, there are a lot more roles that could emerge, new roles that could emerge in the future. They touched upon the liquidity pools out there. How do you make this asset available in these liquidity pools in a secure way? But also, how do you give back to your clients data on the stability of these pools? So there is a massive opportunity, for example, to work with analytics here, and to help to bring out a completely new generation of analytics that can help accessing these liquidity pools. And I think that it feels like the CSD is the right place where these services can start to be made available, and the right place for different users to come and consume these services. So what guides us is this belief that this is going to become a much larger market, more diverse. Where, as Sven said, there is a lot of space for new entrants that we don't even know now, and yet because we don't know what the problems will be. But there is at the moment, and we see more cooperation than competition in solving those problems. And we think that by providing some of the elements that we are best at doing, we can help. And again, it's all about adapting our experience and reinterpreting new products based on the old knowledge that we have, and transforming that into new knowledge. But we see the sides of the opportunity, and we don't see it as a departure, but more as an evolution.
Mm-hmm. Sven, we're into our last 4 minutes, 3.5 minutes left now, and there's a couple of questions I'd like to address from the audience. But before I do, perhaps some thoughts from you, Sven, about it's not as if the traditional custodian banks and traditional CSDs have really leapt at this opportunity, either for cryptocurrency or for DeFi or indeed for security tokens. When I look at that list of 100 odd digital custodians, there's only 15 banks in it, and a lot of them are private banks. So the traditional industry has been quite cautious about this opportunity. What's the view at State Street about DeFi, bearing in mind that 97% of the defalcations the first quarter of this year were DeFi protocol thefts?
I mean, we're very intrigued by this, and I think there's also a lot to learn how you could use some of the maybe more technical aspects for things like collateral management, etc. But the reality is, I sometimes I think like I'm a broken record, but regulation is a concern because we are a globally systemic important bank, a GCFE bank. There are regulatory obligations imposed on organizations like State Street that are absent from more fintech type driven organizations. And so if you look at the moment, some of the core aspects to DeFi, everyone can play a self-service. There's no product regulation. There's no suitability really criteria for these products. That is somewhat at odds with traditional regulation in terms of requiring a bank to determine, whether that particular product is suitable for a certain type of investor. So something has to give. There are ongoing debates also with regulators about what has to change or what are the circumstances under which you would allow banks to participate. But right now, DeFi is something that the way it's being structured would make it very, very difficult for a highly regulated bank to actively participate in. But we're looking to find ways to do that. And for instance, staking is one of the areas that maybe is more confined, and there are probably easier ways to provide services there within our framework than maybe more complex structures.
Mm-hmm.
I can just add a point there to Sven's comments. Yes. I think historically, if we look at I like to see technology driving some of the regulatory decisions. Now, if the technology is not understood at its core by the regulators themselves, then it's very difficult to get that implemented. I think there's been a good job in recent years to really get up to speed and educate yourself around, distributed ledger technology, staking as a service, core blockchain implementation, the protocol layers, all these interoperability layers. People are getting more and more of an understanding about how this space is operating. And I think that's helped. I think if you go back sort of 5 years, it was pretty minimal actually in the understanding about how this space could actually affect the traditional custodian world. So I think that's improving all the time. And I think it's clear that the big institutions are spending a lot of money by bringing in teams of blockchain experts or cryptographers or otherwise, right, to bring into their mix, to add to their existing pool of talent to actually, help this move along. And I think that's a good sign.
Our time is up, but I'd like to sort of deal with a couple of questions from the audience. One is from Saeed Abdul Zilani. He says, hello, my question's in general. I'm a capital market professional from India. There aren't many discussions happening here for CBDC or tokenized securities. I see great potential for instant settlement with blockchain tech. You're absolutely right about that, Saeed. We were talking about custody today. We have talked about CBDCs in 5 or 6 previous webinars, which you can find on our website. We've also talked about tokenization of securities probably 4 or 5 times. All that information is on our site. Here today, our topic was really securities. But what I like about Saeed is he said, what advice can you give us for someone who wants to switch his career towards digital assets? So is the answer to that, Dale, to get into custody?
That's a really good question. It depends on their background, but I'd say there's a huge demand, there should be, in the fintechs that really they have a dearth of TradFi experience. We really need to pull in people who have TradFi experience, and you can bring them up the curve quickly on methods and mechanisms within the digital asset space would help augment their career. So I think there's huge demand for people from TradFi at this point.
Saeed has corrected me to say that he meant it's not being discussed in India rather than it's not being discussed generally, but forgive me, Saeed, for misunderstanding your question. Irving Vienna's asked, what impact or changes the tokenized assets have on the current settlement infrastructures involving fiat? Can you touch on this? Again, we've talked about custody rather than settlement here, and I'm not sure what we can add with only 30 seconds to remain. But Dale, what would your advice be to Irving?
I think the reality is now with DLTs and the mechanisms that we have with digital assets, that the realities of how we handle and manage fiat will be the same. And so we'll be able to actually move quickly to instant settlement networks. I think we're seeing that already. I think one of the disadvantages that the current markets have is there's a bunch of private networks that aren't linked together. And so I'd look for more and more mechanisms to be able to link all those private markets together to be able to provide settlement across all different sorts of asset classes, especially I would say was referred to earlier, more of the traditional illiquid ones or ones that have not been had access more broadly. Private equity is another one, as well as real estate. Right? I think those are, look for major changes there, because the even T+2 is painful, right? Let's be clear, but real estate's, T+30, T+45. So.
Yeah, and we do see DTCC, a CSD, moving into the privately managed asset space to build an infrastructure for that. So we will be touching upon that in future webinars. But I don't want to let you all go before you have at least one last say. And I'd like to go back to that question about who's going to be the winners, because I'm not sure we've really answered it here. The global custodian banks, the startups, the suppliers of technology. Who do we think is going to, if we agree, and I think we do, that custody is going to be a very important component of the growth of the tokenized security markets in particular? We were talking about that just a second ago. What's your view if you look 5 to 10 years ahead, and we can expect this market to consolidate, we can expect global custodians to actually buy some of the better startups? What do you think it's going to look like? Is it going to be an oligopoly like global custody today, where 80% of the assets are with 4 large banks, or is it going to be completely different from that? I can see Dale disagreeing with that, but I'll let you speak in a minute. Sven, what do you think the market is going to look like once it's gone through this chaotic phase of growth and fragmentation and consolidation?
Yeah, I mean, obviously would depend on like who's having the right answer to make sure that the client base can grow their business in that space. I think a lot will depend on the ultimate structure. So if you just take the one extreme view, all that's really going to happen is traditional market infrastructures deploy some DLT and nothing really changes, then I think you may lead to one outcome, that if you want the traditional roles and traditional industry stays as is, or you move to the other extreme where you would have fully permissionless networks, market infrastructure in that sense don't really exist, and then everything is up for grabs, and you change the definition of what a custodian does, which is more like a network orchestration service, and you pull in, you do the audits you mentioned already for smart contracts. And so with that comes the question of, is there still a banking service that is subject to Basel III rules and all of these kind of things or not? And all of that is, I think, up in the air. I think for us it's very important that we provide maximum flexibility. I want to have optionality. If a fintech provider has a good solution available, we make it available to our clients. There's no more this thinking of it has to be built in-house in order to be successful. I think that will drive it, and that's why I'm really thinking about this in a very complementary sense, as opposed to one versus the other.
Massimo, a year ago, our discussion was all about CSDs would be disintermediated. Here we are 12 months later. You not only have a traditional CSD, but you've built a whole digital CSD, as you alluded to earlier, looking for a transition from traditional securities markets to security token markets, and you expect to be able to service both parts of that transition. What do you think the CSD industry is going to look like in 5 or 10 years' time? Who is going to be the winners? Is it going to be you and DTCC and others who are early into this market, or is it going to be something completely new and different?
I think that is going to be something new, and I think that the winners will be enablers. The enablers, as I said before, who stand between the different nodes of this network, different representatives nodes. Whether the enablers will be us or DTCC, a traditional fund, a traditional FMI, or even banks who take that role, that is too soon to say. I wouldn't speculate on that, but I think that in terms of the function of their function, the winners will be the ones who are enabling, facilitating, curating, orchestrating all these processes, and they will have a different a different business model, a business model that is made of smaller little revenue touch points along all this line. They will extract rents, smaller rents, but from a lot more specialized and confined roles. For example, a lot of fintechs don't want to get regulated. They look at us in a way to access regulated service and provide bridges into regulated services because they don't want to become market operators regulated themselves. So that is one role that we could potentially expand, and so can other exchanges. But again, whether it's going to be us or others, I don't know. But I'm fairly sure that the way they're going to look like is, as I said, someone who is there to enable processes.
Neil, you're placing bets on what's going to work here. Is it going to be creating a business and selling it to State Street, or is it going to be extracting rents from obscure corners of the marketplace, like Massimo suggested?
No, I think there's going to be multiple players. It's very difficult to say about the winners and losers. Of course, for us, if we're trying to capture the life cycle management of digital assets end to end, right, we will either look to go and buy or we'll build ourselves. We took the approach of building ourselves when we couldn't find anything that met our requirements in the market early on. But if it's something that we can have, interoperability between our other components within the lifecycle management of assets, whether that's clearance and settlement, whether that's digital identity, custody, trading, access to exchange connectivity to be able to get best execution on multiple venues around the world. I mean, we want to have the best solutions for our investors and families and clients. Whether those who's the winners and losers, I don't know. We want to back infrastructure in the space from an investment standpoint. And we then want to create tools to have the management of those assets. So digital asset management is right on the forefront of our mind. So yeah, winners and losers, difficult to say. Of course, it's clear that the big institutions are backing this in a big way. But yeah, we just build ourselves where we can't find it, but we'll buy or we'll investing and or utilize or integrate with a platform if we don't have it in our own toolkit.
Dale, a last thought from you. You were disagreeing with me a minute ago when I forecast a full bank oligopoly in digital assets.
Yeah, so
why was I wrong?
So let's look at the market itself. And just in general, there's a whole set of assets which are not available for trading in any reasonable form. They may be available, but they're in small private markets. Imagine a flood of all of those different assets types, and it's going to take more than 5 years, maybe 10 years, maybe 15 years or even longer for a majority of those assets to really make it in digital form and to begin trading and to begin the generation of revenue and wealth. And so it's going to be the enablers that allow those assets to come to a digital form, that can be maintained on them, that can do reporting with those, that, in the case where regulation is required, that regulatory oversight is going to be. So there's a massive wave of new assets that are going to be available for money and investment, and that's going to drive an incredible amount of innovation and growth. Not clear who the winners are going to be, except those people who are able to embrace those new assets as they're coming on and service them are definitely going to have a great revenue stream.
Thanks, Dale. Last word from you, Johan. The future is very hard to predict. In fact, it's impossible. But how do you expect this to unfold?
Yeah, I think
winners of the future, if you like.
Probably have two extremes: the oligopoly stage that you referenced earlier, and then the world of Web3. And the world of Web3 is the birth of a new internet. The financial system around that is called DeFi, and I suspect the infrastructure required to store and manage keys will look far different. Now, the truth is probably somewhere in between those two. It's probably a combination of both. And I think I agree with the panelists that enablers is going to be very important in bridges. And that's certainly what we think very deeply about. And that's what we enable, bridging into Web3. And with that, I think probably, we take a very custodian agnostic approach. And I agree with Dale's statement that I think the infrastructure that will allow the enablement of this ecosystem to grow, of digital currencies to grow, the players are going to sort of win in the future.
Well, that's a good thought to end on. I think something that's common to all five of you is this is all about the infrastructure which enables these things to happen. We've run over, so we must stop there. I'd like to thank our panelists, Massimo Butti from SDX, Johan Bormann from MetaMask Institutional, Sven Werner from State Street Digital, Dale Quantz from Polysign, and Neil Fillery from Shuttle Holding and Digital Asset Custody Services. I'd also like to thank you, the audience, for your questions and your comments. Here at Future of Finance, our next webinar is on Wednesday, 22nd of June. And in it, we're going to be asking, has the drive to reform cross-border payments lost its mojo? I hope lots of you will be able to join us then.